Hello and welcome to Options in Plain English Advanced Edition. Today we'll talk about the Double-Double Iron Condor, and in general we'll explore ways to better utilize our capital when we use defined risk trades such as, in this case, Iron Condors. An Iron Condor, as we know, is made up of two vertical spreads, a short call spread here and a short put spread right here. So the current price is in the middle, and this strategy is betting on price staying inside a range. Because of this, thinking very logically, most traders start out thinking that it's very easy to put on a very symmetrical Iron Condor where the distance between the price and the short legs is the same on the call side and on the put side. So it's equidistant. So the distance from the price to the short call is equal to the distance from the price to the short put. Also, by making it perfectly symmetrical, what they would have is a put spread width that is the same as the call spread width. So you have a perfectly symmetrical Iron Condor, looks really nice, but one of the disadvantages of using an Iron Condor like this is that the deltas for these different strikes are not symmetrical because number one, prices are log normal so that on the downside they can only go to zero, and on the upside they could go to infinity. Because of this, the deltas are not moving at the same speed as you go further from the at the money. Also, there is something called implied volatility skew, which makes those implied volatilities on the downside different than on the upside and in the middle. Because of this, the deltas don't behave exactly the same as you go from the at the money down than they do when you go from the at the money and up. So this Iron Condor looks very symmetrical, looks very nice, but it's not delta neutral. Why? Because if this distance is the same, say for example in a usual equity situation, when you have reverse skew, so the implied volatility on the low strikes is higher than the implied volatility on the high strikes, that affects the delta, and that makes those strike prices have different deltas than the strike prices on the cost side. Because of this is not going to be a delta neutral strategy. If you want to put on a delta neutral strategy and you want to pick an Iron Condor, what you need to do is make it dynamic. What does that mean, dynamic? It means consider the deltas that you want to use and then make sure that the deltas for your shorts are the same on both sides. So the absolute value of the delta 2, in this case the short put delta, is the same as the delta on the delta 3, which is the short call. And also the wings should have the same delta. So delta 1, which is the one at strike price 1, should be the same as delta 4, which is the long call, that is the wing for the call spread. So this 1 and 4 should be the same absolute value of delta. We're not going to talk about signs here, but for example, if you want to put on an Iron Condor and you want to make it dynamic, you want to make it conform to delta instead of conforming to the distances between prices and strike prices, then what you would do is you would take a look at the deltas, and let's say you want to put on a 15.5. So 15 for the shorts and 5 for the longs. In that case, you would have the short put is going to be at 15, and the long put is going to be at 5. The short call is going to be at 15 as well, and the long call is going to be at 5 as well. Now you're going to have a perfectly balanced Iron Condor, and that's going to allow you to have a delta neutral Iron Condor. Okay. A consequence of this, of working with the deltas, is that the widths of the the widths of the Iron Condor, the short put and the short call are probably not going to be the same. They might be, but they might not be the same. And what happens is in usual reverse skew, which is what happens with equities for the most part, what you're going to have is the put spread width is going to be higher. So it's going to be bigger than the call spread width on the call side. So the put spread is going to be wider, the call spread is going to be narrower, and that's the Iron Condor you're going to end up with. Since you are focusing on having the deltas be exactly what you want them to be, this is not critical for you. However, if you think about it and you realize that the buying power reduction is based on the max loss that you can have on any of the sides. So in this case, for example, you want to know the buying power reduction that you're going to have in your account for this Iron Condor. You're going to have to find out what your max loss is, and the side that's going to be wider is going to contain the potential max loss. So this one, because it's wider, you're going to have to put up the capital to carry this position to cover for this loss, for the loss on this side, because on this side the loss is less because the width is less. Because if price starts here and ends up over here, you're going to lose from here, from the short call to the long call, minus the credit you received, and that's going to be a loss. It's the same thing for the put, short put minus long put, or rather short strike price minus the long strike price minus the credit that you received, and same for the call. So it's strike prices. You can easily see that the max loss is going to be on the put side. And this might be an indication that maybe this strategy, this structure is not as effective or as efficient at utilizing capital as you could have if you made a few modifications or a few tweaks to this basic structure. So what could we do to better utilize our capital? Well, one of the things you could do is, if the put spread width is greater than 2 times the call spread width, so in this case, for an equity product, this would be something that happens all the time. This put side is going to be wider than the call side and is going to be wider by a lot, let's say by a ratio of 2 to 1. Then if it's greater than 2 times, then you can add an additional short call spread to the call side, and it's not going to affect your buying power reduction, because this multiplied by 2 is still going to be less than or equal to the width of this put spread. So your buying power reduction stays the same. You get additional credit from an additional short call spread, and the utilization of capital is going to be higher. The return on capital is going to be higher because you're not going to be using any more capital. The capital is going to be based on max loss, and the max loss is still the same because this width is, like I said, at least 2 times wider or greater than this call spread width. So there is an additional short call spread on the call side. So you get the same buying power reduction, but you get a higher credit. And because of this, you're utilizing your capital in a more efficient way. Now, remember, you have an additional call spread here, short call spread here on the call side. So you're going to have a 1 short put here, 1 long put here, 2 short calls here, and 2 long calls here. The buying power reduction is going to be the same, but something changed. Now your direction is not going to be perfectly neutral. This new Iron Condor is not delta neutral. It was initially without the additional short call spread. Now it has an additional short call spread that results in negative delta. So you have positive deltas from this short put spread, positive deltas from this original short call spread, and then the additional one provides you with additional negative deltas. Return on capital is going to be higher because no additional BPR is being used and the potential profit is higher, so because you get a higher credit up front. In this example, we analyzed a scenario that is typical of equity products that present usually reverse skew. This can be applied to underlyings with forward skew as well, for example, commodities. But in that case, the call spread is going to be the one that's going to be wider, the put spread is going to be narrower, and at that point, you can add additional put spreads on the put side. And then now you're going to have a better utilization of capital, but you're going to have an iron condor that is not neutral, is going to be in that case long deltas. Okay, so wherever the skew is where your short spread is going to be wider. You go to the other side and take advantage of the fact that you have to use the wider spread on the other side anyway. So what you do is you put on additional spreads. Could be call spreads in the case of equities, or could be additional put spreads in the case of how commodities usually behave. Also, in this example, we had a ratio of a put spread width to the call spread width of 2-to-1. If the ratio is higher, you can add additional spread on the narrow side. So if it's 3-to-1, you can have 2 additional spreads on the call side. If it's 3-to-2, then you can have 2 on one side and 3 on the other. And that's how you're going to be maximizing your use of capital. Just remember, this iron condor is no longer neutral. Now you have a directional component, but your capital is being used in the most effective way given these constraints. The main objective when looking at strategies in this way is to find a way to better utilize our capital, which is reflected in a higher return on capital. So this is all we're doing is we have a defined risk trade. We're putting up some funds, some money to carry the position. We want to make sure that we can extract, that we can squeeze as much as we can out of that position into our account as profits. Now we're going to go to the platform and we're going to be taking a look at a real example where we can apply and we can see this in action. So now we're here on our trading platform and I pull up all the information for SPY, which is the ETF for the S&P 500. And let's open up the June 19th of 2020 expiration. And we're going to take a look at all the different strikes. And what we're going to do is we're going to put on an iron condor, but I'm going to use a dynamic iron condor. And I'm going to be putting on the 2015 delta on both sides. So I'm going to go and start with the put side. The 20 delta is 273 right here, and the 15 delta is the 266 right here. Okay, so 273 is the 20, 266 is the 15, and you have the put side. Now I'm going to do the same thing on the call side, where I'm going to come here and I'm going to go to, here we have 21 and 19. So I'm going to go, we don't have a 20, but we have a 21, 19. I'm going to go with the 19. I'm going to sell the 311 and I'm going to buy the 15, which is the 314. Okay. So here we have it. We have an iron condor now, which is the on spiders SPY for June 19, 2020. The strike prices are the 273, 266 put spread short, and the 314, 311, or rather the 311, 314 short call spread. Altogether, I'm putting this on for 143. Okay. Now, if I go here and I hit confirm and send, just gonna take a look here at the buying power effect, which is the same as the max loss. It's going to be $557. Why? Because we have a $7 wide short put spread where we're collecting on the whole Iron Condor, we're collecting 143. So the max loss is not 700, which would be the width, but 700 minus 143, which takes us to 557, which is the buying power effect. So for $557, which is the max loss, we're putting on this position where we can make up to $143, okay? So what we're going to do here is we're going to analyze this trade, okay? And we're going to put it aside for a while. And what we're going to do now is I'm going to take the same strike prices, but noticing that the width of the call spread is only $3 and the width of the put spread is $7, I notice that the width of the short call spread is half or less than half. So the width of the put spread is more than twice the width of the call spread. Because of this, I can add additional call spreads. So I'm going to break up the Iron Condor here. I'm going to make a custom. And what I'm going to do is, as a single transaction, I'm going to go and take a look at the call side. And I'm going to increase, instead of one short call, I'm going to go two short calls. And instead of one long call here, I'm going to have two long calls right here. So right away, my credit goes to 199. Okay. And what's going to happen is if I hit confirm and send, you're going to see that the max loss is actually now 503. It's less than 557, what we had before, because the max loss is still on the put side, because the call side is $3 multiplied by 2. So it's as if it was $6, but the put side has a width of $7. So it's still the main where the main risk is. So one of the things we can see is same buying power effect, in fact, less buying power effect, higher credit. So all in all, a better use of capital. So let's send this one to analyze. Okay, so we have both. I don't care about the price slices here. Just gonna put it up here a little bit so we can see it better. Okay, so this is the original Iron Condor. Okay, we can see that the max loss is over here, and we're putting it on for 141, 143. It's fluctuating. I'm opening it up so you can see the price is changing in the market. And the variation, which is the double-double, I'm putting up 2. And as you can see, now it's a little bit more balanced because the max loss is still here on the put side, but at least we're going a little bit further with our call side, and we're collecting an additional amount for an additional call spread that we're selling on the upside. Now, if we look at the Greeks, we're going to open these up right here. Okay, so let's analyze the first one. The first one is a very balanced Iron Condor, and you can see it here. The delta is 0.27, which is very, very little. It's pretty much no delta. So this is a delta neutral Iron Condor. Okay, a delta neutral Iron Condor that's making 143, and where I'm putting up 700 minus 142, so 558, 557 to carry this position. The other one is a double-double Iron Condor, and this one has a delta component, minus 4.29 deltas, and it's fluctuating. But this one, I am putting up pretty much $500 because it's 700 minus 198, so $502, $504 to potentially make 196. I have a delta component Okay, so I have a negative delta. The price is here. And what this is telling me is, if you look at the graph, it's telling me that I want this to go a little bit lower in price. So I want it to go here, which is not such a bad thing, because as you can tell, the actual position is not dead center between the short legs of our spreads. You can notice here, price is here. This is, that center would be somewhere like here. So you want it to go to the center. So you want it to go low in price, which is not such a bad thing, like I said. So in this case, I am willing to take on those negative deltas in exchange for a higher credit. Because what's going to happen is, when I put this on, my objective is not to wait for it to expire worthless. My objective is to get, in this case for iron condors, anywhere between 25 and 50% of max profit. So as time starts passing, you're going to see that your profit line is going to start expanding here. Let's change the expiration date here. So your profit line is going to be expanding as time passes, and what you want to do is you want to take this off when you get between 30 and 50%. So when you've made, let's say, $100 out of the 200 potential dollars that you can make, you're going to take it off. So at that point, you have your objective for this trade, and in doing so, you're removing all the risk of keeping this position all the way up until expiration, where you would have to deal with gamma, with a heightened level of gamma, and some other issues that come up when you hold things very close to expiration. So just to summarize, an iron condor, if you want to make it delta neutral, sometimes the widths of the spreads are not the same. If one is substantially larger than the other, then you can add additional spreads on the narrow side, and in doing so, you're going to be modifying the delta, but you're going to be receiving an additional credit, which with no additional buying power reduction, which is going to make your return on capital much better, and is going to allow you to take this trade off sooner, because now you're going to go for 50% of a higher price, and it's probably going to come down in price. The whole iron condor will, giving you some profits much sooner. So iron condor, delta neutral. Double-double, it's not delta neutral, but it has higher credit, same BPR, and because of this, higher return on capital. And because of this, is a good alternative for you to think about when you're trying to put these positions on. Thank you very much for your attention. I hope this is going to be helpful for your trading, and that it helps you become a better, more informed, more analytical trader. Thanks very much, and goodbye.